Most traders would never take this trade, and honestly, I understand why. When I looked at this setup, there was no clean market structure shift that most traders wait for. The price action looked messy, the confirmation was unclear, and that is exactly where most traders get stuck. But what if I told you the market was still giving a high probability sell setup? Let me show you the confirmation that almost everyone missed. Stay until the end, because understanding this concept can completely change how you approach confirmation in the market. Before looking for any confirmation, I always start with the higher time frame bias. In this case, my higher time frame bias was bearish, which means I was only interested in looking for sell opportunities. I also had this bearish break of structure, showing that sellers had already taken control of the market. So rather than looking for buying opportunities, my focus was to follow the bearish direction and wait for price to move into an area where smart money might be interested in selling again. Once that bias was established, the next step was to understand where liquidity was resting and how price was likely to reach it. Once my bearish bias was established, the next thing I noticed was this inducement. Many traders were seeing the bullish momentum and expecting price to continue moving higher. This is exactly what inducement is designed to do: encourage traders into the wrong side of the market while liquidity builds above. Smart money needs liquidity to execute larger positions, so before the real move begins, price often creates an attractive narrative that pulls traders in and provides the liquidity needed for the next objective. After the inducement was created, price started rallying aggressively to the upside. Now, many traders would interpret this move as strength and begin looking for buying opportunities. However, because my higher time frame bias remained bearish, I viewed this rally differently. Instead of chasing the move higher, I saw it as price moving toward a specific objective. The key question was not why price was rising, but where it was rising to, and what it was trying to achieve before the next move. And that objective became clear when price finally delivered into this supply zone. This was the area I had been waiting for since establishing my bearish bias. The aggressive rally had now pushed price into a premium area where selling pressure was likely to appear. At this point, I was not interested in buying the bullish momentum. Instead, I wanted to see whether the market would respect this zone and provide confirmation that sellers were preparing to take control once again. Now, this is where most traders would be waiting for a clean market structure shift before looking for an entry. And technically, there was a market structure shift on the lower time frame. The problem was that it was not clean. The price action was very noisy. There were multiple small breaks within the structure, and there was no strong displacement that gave me confidence in the shift. In situations like this, I do not force a trade simply because a market structure shift exists. Instead, I look for the strongest confirmation available within the current market context. Since price had already reached a higher time frame supply zone, I needed another confirmation that sellers were actually stepping into the market. And that confirmation came from the bearish order block that formed after the reaction from supply. Instead of relying on the market structure shift, I used this bearish order block as my confirmation. After price reacted from the supply zone, a strong bearish move created this order block, showing that sellers were becoming active in the market. What I wanted to see next was whether price would return and respect this area. When price came back to mitigate the order block and failed to continue higher, that gave me the confirmation I needed to start looking for a sell entry. This confirmation was much cleaner than the noisy market structure shift. After the bearish order block was formed, I did not enter the trade immediately. Chasing price after a strong bearish reaction would have given me a poor risk-to-reward ratio. Instead, I patiently waited for price to retrace back into the bearish order block. After some time, the market returned exactly into that area, providing a much better location for a potential sell. This is why patience is so important. Sometimes the market gives you the direction first and the entry later. By waiting for price to come back into the order block, I was able to position myself with a clearly defined risk and a much more favorable setup. Once price returned into the bearish order block and did not enter immediately, I wanted additional confirmation that sellers were still in control. As price reacted from the order block, we got a strong bearish displacement, showing clear selling pressure entering the market. That bearish displacement became my final confirmation. With a higher timeframe bearish bias, the supply zone reaction, the bearish order block, and the displacement all aligned, I executed my sell entry with a 1-to-3 risk-to-reward ratio. At that point, the market had given me everything I needed to take the trade with confidence. Before reaching the larger target below, price first delivered into this internal liquidity. This is an important concept because the market does not always move directly toward external liquidity. Very often, internal liquidity acts as a stepping stone along the way. Once sellers took control, price naturally targeted this nearby pool of liquidity first before continuing its move lower. This gave further confirmation that the bearish narrative was playing out exactly as expected. After delivering into the internal liquidity, the market still had a larger objective below. That objective was the sell-side liquidity resting beneath these lows. Once sellers gained control, price continued moving lower and eventually swept that liquidity. This is exactly why I always pay attention to liquidity targets. The market is constantly moving from one pool of liquidity to another, and in this case, sell-side liquidity became the final destination of the move. Before ending this breakdown, I want to share the most important lesson from this trade. Many traders become too dependent on a single confirmation, especially a market structure shift. The problem with that approach is that the market does not always provide perfect textbook setups. If I had ignored everything else and focused only on finding a clean market structure shift, I would have completely missed this opportunity. Instead, I focused on the complete story the market was telling. My higher timeframe bias was bearish. I had a bearish break of structure. Price created inducement, rallied aggressively into a higher timeframe supply zone, and then formed a bearish order block after a strong reaction. Even though the market structure shift was noisy, the overall narrative remained clear. The market was giving me multiple reasons to look for a sell. The lesson is that trading is not about collecting confirmations. It is about understanding context. The strongest traders are not the ones who memorize patterns. They are the ones who can adapt when the market does not look perfect. When you learn to read the story behind the chart, instead of searching for a single signal, you start seeing opportunities that most traders completely miss. At the end of the day, this trade was never about finding a perfect market structure shift. It was about understanding market context, liquidity, and adapting to the confirmation the market provided. The market will not always look clean, but when you learn to read the story behind the price action, opportunities become much easier to identify. If you enjoyed this breakdown and want more educational trading content like this, make sure to follow, and I will see you in the next one.